So very good evening to all of you. Thank you for joining us on this weekend. And I am Ankit Kanodia, co-founder and partner of SmartSync Services. And here we are on our 12th webinar in the series of Mission Smile. And today we'll be talking on QSR, Quick Service Restaurant. Just let me know if you can see my screen. I'm just sharing it right now.
Yeah, it has come up, Ankit.
Yeah, so thank you. And I'll request everyone to just be on mute. If you have any questions, please type on the chat box, and we'll keep after 15-20 minutes or maybe half an hour, we'll keep on looking at the questions. But we would really appreciate if we can all be on mute so that nobody gets disturbed, right? So let's get started now. Basically, we'll be trying to answer these three questions. Why should one look at the QSR sector now? What are the important metrics to track the progress of QSRs? And which are the players you can bet on? So some of our Mission Smile members actually had this feedback. They wanted us to first present on a sector and then give choice to the members to pick which of the companies they want us to deep dive on. So today we'll cover the whole sector in detail, and then we'll have a bird's eye view on top 6 companies in this space. And post the presentation, based on you need to answer today itself. You may answer it today or maybe sometime later in the Slack channel. And based on your votes, we'll cover 1 or 2 companies in detail from this QSR space, right? So I don't know how many of you know about this, but Elon Musk will sell burgers. So let me know if you can hear this, hear the sound of this video. It's a very short video. Achilles, is the sound audible for you?
No, Ankit, it's not coming up.
The sound is not coming up?
No.
Okay, no problem. Is it coming up now?
Yeah, it started a while back.
Yeah. So I just paused the video. So let me start from beginning.
No, again, there is no sound.
Sound is not coming?
No.
Okay. You can see the screen, but you can't hear the sound.
Right.
Okay. Let me just check that.
Maybe you have to make the changes in the volume levels of the video right there on YouTube as well.
No, it's top volume.
What about the system volume?
System volume is also top.
I can hear you, but not the video sound. Anybody else has the?
Is it the same for all, or?
Yeah.
Okay, nobody can hear it. So what I'll do, I'll just copy the link of the video. You can and share it on the chat box so that you can watch it. It's a 1-minute video. That's not a problem. Just a second.
Let's try once again whether it works.
Okay.
Is Karan there? Let me try and project that video if that is possible.
Karan will join in a minute. Just a second. I'll. Okay. Is it coming now?
No, Ankit.
Let's not waste time over here. We'll check it later on. I'll just share the. This is the video link. You all can watch. So basically, what we want to share over here is that. Let me just explain it to you. So what Elon Musk is doing over here is he has figured it out that if more people are going to buy Tesla, more people will get their cars to get on the gas station to be get on the station to be charged, and it takes time to get these electric vehicles charged. Sometimes 1.5 hours. So what will they do once they wait for it, right? So that is when this idea came to him that why not open QSRs and give them food to eat, and that is how they would be able to spend some time, right? I hope my slide is visible, right?
Yes, it is Ankit.
Okay, great. Okay. Now, from burgers, let's come to pizzas. So much of talk has been there in the last 2-3 years regarding the tech companies, specifically in the US. But look at how Domino's has fared compared to these FANG stocks in the last 7-8 years. So, of course, after 2017, there has been a surge in all these stocks. But for a long period of time, Domino's was clearly outperforming all these tech stocks. So there must be something in the business of Domino's, and there is something which is very much durable in companies like Domino's or in the QSR space, which helps them make such a good, sustainable return over a long period of time, right? Now let's come to this book, which was written, which is a very famous book, and we would highly recommend. I'm sure most of you would have already read it, but if you have not, if you are a long-term investor, this is one book which we would highly recommend that you should read. So this is one snippet from that book, The Little Book That Builds Wealth. It was written by Pat Dorsey. And over here, if you see, there are 3 things we need to note here. What he writes is, being a big fish in a small pond is much better than being a bigger fish in a bigger pond. Focus on fish to pond ratio, not the absolute size of the fish. Second, delivering fish more cheaply than anyone else can be pretty profitable. So can delivering other stuff. 3, scale economics have nothing to do with the skin on a fish, but they can create durable competitive advantages. So what learnings can we take from these snippets from the perspective of QSR? Let's look at it one by one. So number 1 is fish in pond. So QSR, if you look at all the QSRs which are around you, forget about listed businesses or unlisted businesses. What you can see very clearly is that these QSRs or these quick service restaurants, some of you might be confused as to what are QSRs or what actually, how do we define? We'll cover that in the subsequent slides. But for the moment, just understand these are some restaurants like KFC, Domino's, Pizza Hut. If you look at them, scalability and market share is what matters. How much you can scale your business and what kind of market share you can gain. Number two, delivering fish or basically logistics. Many people or many investors rather don't understand this important fact about QSR. QSR is less about the quality of food. That doesn't mean the quality doesn't matter, but it is more about the logistics. And in subsequent slide, we will cover and you will understand how important the point of logistics matter, right? So logistics matter more than the quality of. Again, if you can grow fast, if you can scale, if you can provide more convenience, even if you have a reasonable quality, you will do a much better business as a QSR. Now, what better way to understand about QSR than to look at the number one player in the world of the QSR. So Domino's is probably the best example of QSR, and it has a long history in the US market. So let's look at the journey of Domino's. So we have just tried to look at the different vision and mission statements Domino's used to have over the years. In 2004, they used to say, exceptional people on a mission to be the best pizza delivery company in the world. So delivery was very important for them. And that is why we have kept it in bold. In 2012, exceptional franchisees and team members on a mission to be the best pizza delivery company in the world. Again, delivery. And in the last 2-3 years, to be the leader in delivering off-premise pizza convenience to consumers around the world, to lead the internet of food in every neighborhood, to redefine convenience by creating inspired food picked up in 3 minutes or safely delivered in 10. Just try to understand over these last 20 years, what they are trying to harp upon are 2, 3, 4 important facts. One is they want to be the best delivery player. Second, they want to offer their customer most convenient way of getting that food. Third, they also want to take the advantage of internet. And fourth, they understand that being quick has an edge. And that is why they always focus on a particular time period. So they always have this, if you don't get the pizza in 30 minutes, it is free for you, right? So these are more important factors for QSRs than the quality of food. So if you look at the quality of pizzas, just try to understand the pizza market. So there are many players, regional players also, and it is growing really fast. Not just Domino's, there are smaller regional players who are also growing fast in their region. And there is not much difference in the quality of pizzas which is being delivered by Domino's or Pizza Hut or something like, say, in Western region, we have Lapino's. In fact, some people say that even Lapino's pizzas are much better than Domino's pizza in terms of offerings, in terms of taste, but still Domino's is a different brand altogether. So that is why when as investors, we are looking at the QSR space, it is important for us to understand that probably the best companies, be it in pizza or burger or any other segment, that company should be focused more on the logistics of delivering the food rather than just preparation of the food and quality of the food, right? Now let's try to compare Pizza Hut and Domino's. We all know that they all started at the same period of time. Late 1990s, around 1996, they both started at the same time. But look at the stark difference of where Domino's is today and where Pizza Hut is. And I don't know about all of you, but I remember about my college days. So during that period of time, I used to like Pizza Hut pizza much more than Domino's pizza. So from quality perspective, probably Pizza Hut was better than Domino's. I'm talking about the period of 98, 2000, 2002, something like that, right? So that was a time when the quality of Pizza Hut was, and it is not just my personal opinion, it was the general market opinion or view on the quality of pizza made by Pizza Hut and Domino's. And at that point of time, there were not much difference in terms of scale. Of course, Domino's was still a little more scalable compared to Pizza Hut, but that difference was not too stark. But where did Domino's outsmart Pizza Hut? And that is only in logistics. The way they started focusing on delivery, the way they put convenience more important. In 2007, they introduced online booking. Pizza Hut didn't have that online booking for a long period of time. And Pizza Hut was focusing more on the dine-in, wherein Domino's had this really figured out way ahead of the industry that delivering to their home is actually a very good way of increasing your sales. So if you go back and look at some of the points, number one is convenience. Number two is how fast you can deliver matters. Number three is availability of stores. And number four, quality does matter, but not that much. So of course, if Domino's would be making poor quality pizza, nobody would be having Domino's pizza today. Of course, their quality is kind of at least much better than the acceptable standards, right? So that is why it is clear. But quality alone cannot do the thing for you. And if you look at the result of all these efforts, see where Pizza Hut is and see where Domino's is. Domino's store count is 2.5x of Pizza Hut. Domino's revenues today is 6x of that of Pizza Hut, right? So it's not just being online or making yourself available to order online makes the difference. If you understand the difference of how Domino's work and how others work, you will see the difference here. Domino's is the only chain in the QSR space which continues to keep delivery in-house. And what do I mean by continues to keep delivery in-house is, even though they are available on Zomato and Swiggy, but when you order on Zomato or Swiggy, in case of any other QSR, the Zomato guy or the Swiggy guy will give you the order or will deliver you the product which you have ordered. But in case of Domino's, they make sure that their own delivery guys pick up the order and transfer it or deliver it, right? So that is where it lies the difference. And because of that, you see, even though they are there on Zomato and Swiggy, the highest number of orders they take is from their own Domino's app. Because as a customer also, if you are going to order Domino's frequently, that means you become a loyal customer. And then being a loyal customer, you don't want too much of clutter and want to choose from 5, 10, 15 things which are not related to your choice. You would rather go to the Domino's app. Plus, in case of Domino's app, you are getting further more discounts and offers. Sometimes there'll be Wednesday offer, Friday offer, 1-for-1 fee, something like that, which a Zomato or Swiggy will never give, because Zomato and Swiggy is an aggregator. For them, Domino's and any other QSR is the same, right? So that is where they have been able to maintain their own in-house control in the whole logistics. Now let's try to understand very simply what is QSR. Okay, QSR is quick service restaurants, we all know, but let's try to break it down into simple parts as to what makes a QSR. QSR means it provides customers food as quickly as possible, as efficiently as possible, preferably no table service. It cannot be that there will be no table service, but preferably they would. So if you ask a pizza, Domino's pizzas franchisee owner, they would prefer that 100% of their food is being delivered to the person's home, customer's home, rather than customer coming to them, because it is much more efficient and cheaper for them and much more profitable as well, right? Quick serve and fast food are synonymous. So when you are talking about quick service restaurants, you can't expect the customer to wait for half an hour or 45 minutes, which happens in case of a fine dining restaurant, right? And franchisee model is something which is generally you can see in almost all the QSRs. So let's now try to understand QSR and compare them with other segments in the food service market. So there are 1, 2, 3, 4, 5, 7 segment. Number 1 is cafe. Then there is QSR, then frozen dessert, affordable casual dining restaurant, premium casual dining restaurant, fine dining restaurant, and pubs, bar, cafe, and lounges, right? Lounges. So you can see what are the difference. So the basic difference is the ARPU. When you look at the ARPU, average rate per unit, of course, cafe and the QSRs will have much lower ARPU compared to the fine dining restaurants or the pubs and bars, right? So you can see in case of QSRs, 75 to 250 is the average ARPU. And it makes sense also. If the QSRs do not price their product in that fashion, why will you go to the QSR? Why you would rather go to a premium casual dining restaurant if you are getting the same price at both the restaurants, right? So that is why when a person or when a typical customer orders to a QSR, there are 3, 4, 5 basic things which intuitively comes to his or her mind. Those are speed of service, affordability, convenience, options of takeaway and delivery. And even if you walk into a QSR, as a customer, you are mentally prepared that you are not going to get a very good service. You are there. If you say order a pizza or a burger, you just have to order it. They will serve you and you have to take it back. You won't get any service like you get in case of a fine dining restaurant. So those kind of expectations are already built in the customer's mind, right? And that is why the QSR has to be competitive in terms of pricing. This is a portion we took from Devyani International, which is also one of the QSR. When they got listed last year, before that they filed an RHP. And in the RHP, they predicted as to what kind of outlook they look for the QSR, full service restaurant, coffee and tea shop, and pubs, clubs and bars. And it is no surprise that it worked out exactly in the same way. Like you can see, if any of you would have been tracking the QSR space, Q3 FY22 has been their all-time best quarter for almost all the QSRs. So we'll be covering 6 QSR in today's presentation. Almost all, in fact, all 6 of them had their best quarters as Q3 FY22. So that is the kind of recovery we have seen in the QSR restaurant. Why? Again, the pandemic, when it hit, we didn't have the option to go to a fine dining restaurant because all those fine dining restaurants were closed. The only option we had were take delivery. Now, look at it in this way. What are the odds of you ordering to a fine dining restaurant and taking a delivery at home? That generally doesn't happen because you don't go to fine dining restaurant only for the food. You go for the ambience, you go for the whole experience. But when that experience is not going to be there, you are not going to pay that high an amount to just get that food home, right? So that's why during that period, even though some of the fine dining restaurants were having their delivery services, but QSRs continued to do well in their delivery section compared to these fine dining restaurants. And when this pandemic was a thing of the past, or the problems of pandemic started becoming lesser and lesser, we see that this whole habit got ingrained in the people of the country, and we are now getting more used to ordering through QSR rather than through fine dining restaurant. Don't get us wrong. We don't mean to say that fine dining restaurant is not going to work at all. They will have their space, and they are actually doing, some of the fine dining restaurants are also doing well. But the kind of push the QSR segment got, and especially because of the aggregators like Zomato and Swiggy present in this space, that kind of actually accelerated the growth path of these QSRs, specifically in the delivery portion of their business. Now, let's try to understand QSR and fine dining restaurant from the lens of the three levers of ROE. So we did a webinar as we have this series of Triple S Ki Pathshala. Under that series, we had one chapter dedicated to ROE, where we discussed about the three levers of ROE. One is profit margin, other is asset turnover, and the third is equity multiplier or leverage, whatever way we try to talk about it. So different businesses have different levers contributing to the ROE. But if you compare QSRs and FDRs, you will see on all three parameters, QSR by far beats FDR handsomely. And why does that happen? So in case of QSR, because the whole maintenance cost and the running cost is so low compared to a fine dining restaurant. In case of a fine dining restaurant, you have to have a fixed cost in terms of the place, where you have to have a very good place. So that would need high rent. You have to spend a lot on the furnishing. That will again need cost. That will also need repairs from time to time. Then you also need skilled staff who can serve the customers really well and make them feel comfortable. So that means in case of fine dining restaurant, you always have fixed, a large fixed expenses. And on top of it, the sales are not very linear. So there will be times when occupancy will be very high. There will be time when occupancies will be very low. So your costs will be fixed, but your sales will be volatile. That will lead to a lower profit margin compared to a QSR, because in case of QSR, the cost of running a QSR is far lower than a fine dining restaurant, right? Then coming to asset turnover, because in case of QSR, you require lesser assets to be invested in the business. You have a faster turnover on a given asset. Say, for example, just to put some number, if 10 rupees is what is required, or 10 rupees of asset is required for, say, 100 rupees of turnover in case of a QSR, you would probably need at least 30 to 40 rupees of assets in case of a fine dining restaurant. So in case of QSR, the asset turnover would be 100 by 10. That means 10. But in case of a fine dining restaurant, the turnover would be 100 by say 40. So it would be 2.5, right? So that is how asset turnover will also be high in case of QSR. And the last point, which is the equity multiplier or leverage, which means how much equity is required to produce those sales, to run the business. Of course, we all know the nature of QSR and FDR. In case of QSR, you need a far lesser owner's capital to run the QSR compared to a FDR. So all the three levers point out that QSRs are much better compared to FDR, and that is what reflects in the ROE calculation, right? So I think we can wait. If anyone has any questions, we can take that up before we move ahead. Anybody has any questions? Okay. Okay, I don't see any question in the chat box. Anybody wants to ask anything till now, or shall we move ahead?
Hey Ankit, this is Amar.
Yeah, Amar, please go on.
Yeah. So when we talk about this QSR and FDR, now where do we slot some of the restaurants like Barbeque Nation and Absolute Barbecue?
That's a very interesting question, Amar. Actually, I and Karan were discussing on this just in the evening before the presentation. So, strictly speaking, Barbeque Nation would not come in QSR because as we discussed about the ARPU, in case of Barbeque Nation, the ARPU is a little on the higher side. But because post the pandemic, they have focused a lot on the delivery part as well. So for this presentation, we have taken it into account that it is also a part of QSR. And we would not say that it is for sure that it is not a fine dining restaurant. So ideally, it would lie somewhere between fine dining restaurant and QSR. So you can say casual dining restaurant. But from the perspective of today's presentation, we have included it as a QSR because they are also taking a very good advantage of the delivery system, and it started only post the pandemic. I hope I could answer your question, Amar.
Yeah. Thanks, Ankit. One point, like you mentioned, delivery is the focus. And second thing, when I look at restaurants like Barbeque Nation, no, their menu is kind of, even though it's ample and quite variety of choices, but it is fixed. There is no a la carte per se, right? So that also, I think, kind of gives them an advantage where they can like make it at scale and distribute.
Exactly.
So that is where it was kind of hitting me.
Exactly. That's a very good point, Amar. So that is what their edge is, because they don't have a la carte thing. They only have this fixed buffet kind of thing that gives them scale economics, and that is how they have been. So I think Dhruv writing that a la carte has also been introduced. Okay. Yeah. So Dhruv, do you want to
started
say?
an offering named UBQ by Barbeque, so that allows us to order for a la carte services as well. We started after pandemic only, but it's quite recent.
Okay.
And company is seeing very healthy growth in that segment as well.
Okay, great. Thanks, Dhruv. So Kailash, I see your hand up. You can ask.
Yes, sir. Actually, I have a much broader question. Actually, on the QSR, because actually, I do go along with actually my kids, to McD's and the burgers of the world. But actually, there is always a guilt pang kind of thing. Guilt pangs. Actually, they always feel that actually this is something unhealthy food that we are eating. Because all the three among the three kids, this discussion is always there. Kab khana chahiye, week mein ek baar, 15 din mein ek baar, and if you are eating that, you have to skip the dinner. So Buffett has also faced this, thing actually, quite a bit of times actually in his meetings that, females had complained that actually due to your bad habits, bad eating habits, actually, our kids are, going for that thing. So my question is actually, can we say that actually looking at the success of the Domino's, and I had missed the Domino's particularly on this bias thinking that actually, this pizzas, India, will not actually take it up the way Western world has taken. So can you say that the trend is there and it's going to, accelerate, and, the unorganized part, definitely will be getting into, will be losing their plot to these organized QSR, and this, it's a quite a broader question. So looking at, the way the things are actually in terms of culture and in terms of psyche and, on this eating habits. So broader word on this.
So good question, Kailash. So see, there is no doubt about it that all these fast food joints or QSRs are unhealthy. They are not healthy at all. Even though some of them market themselves as if they are healthy, like Subway sandwiches, they market themselves as if they are healthy, but none of them are healthy. But we need to understand from an investor point of view, as a father or as a family person, I would be worried if my family goes to a QSR regularly, right? But as an investor, we need to understand, we need to keep the emotions out. We need to understand what is human behavior. We need to understand how do we work. So we are all food junkies, and there is a evolutionary thing which proves this. So we have been always like this for many years, not just last 10 years, 20 years, 100 years, but maybe 1,000, 2,000, 5,000 years. So this is something which will not go to, which is not going to change. Of course, there will be times, there will be people. So with more and more awareness, there will be a certain section of the people who are really health conscious, and they will completely avoid these kind of food. But increasingly, you will see a higher population, higher majority of the population actually continue to do this, because that is ingrained in our eating habits. It is ingrained in how we think about food, right? So that is why, as an investor, we should focus on these patterns more.
Okay, got it, sir.
Yeah, Akhilesh, you can say you raise your hand.
Yeah, thanks, Ankit. In fact, more than the psyche part, which Ankit very beautifully articulated, we also have to think about the market size. If you think about the total population of India, which is around 1.4 billion people, so 140 crore, US is just 33 crore as of now. So you have 4.5 times of size in terms of growth ahead in terms of market side itself. Even if it is unorganized or some of it is organized in these 5-6 players. So huge scope of growth in future.
Very good point, Akhilesh, and we are also going to cover that in our subsequent slides. So shall we move ahead now? Okay, so let's start. So the evolution of food service industry in India. So phase one was when these formats were getting defined in terms of QSR. In fact, to be very honest, we didn't even know what is QSR. I would request everyone to be on mute. Yeah. So phase one was 2001 to 2010, when this format was getting defined. In fact, QSR, if you ask me, I didn't even know that a word like QSR existed at that point of time. Even though I was using a service of a QSR, eating out in a QSR, but I didn't know that QSR is a word which was. So it was basically restricted to metros and tier 1 cities. And the franchisee model was getting explored, right? And then came phase two, where there was a high growth phase, which was driven by consumer needs, clear distinction between formats in terms of pricing points. So a Starbucks and a CCD was completely different. Similarly, something like a Pizza Hut and a Domino's, and then there were other QSRs where you could clearly demarcate between them. And then industry players expanded beyond tier 1 cities, right? And then came the best phase. If we just ignore the pandemic hit portion, 2016 to 2022 has been not one of the, in fact, the best phase for this QSR, and we believe it is just getting started. So this is a irreversible trend, and we don't know how long the growth is, but because of the presence of these food aggregators like Zomato and Swiggy, then the kind of awareness is not just tier 1, but tier 2, tier 3 cities. So nowadays, booking online is possible in a remote place in many of the remote places in India, right? Now, this is the market structure. So the whole food industry is divided into 3 types of market. One is the organized market, which is chain and standalone. Then there is restaurants and hotels, and then there is unorganized market. So unorganized market, we already know the street stalls, the dabawalas and the hawkers, right? The restaurants, we are well aware, all the good quality hotels, they have their own restaurants. So those are another. And what we are talking today is on the organized market of chain and standalone. And in that we have dining, bars and lounges, and QSRs, right? So that is how the whole market is structured. Now look at the market share of food service segments. So you can see how the market is shifting from unorganized to organized. So unorganized to organized, if you recall some of our previous webinars also, we have been talking about this theme of unorganized to organized, and it works in a lot of industry. As the economy will grow and mature, you will find more and more room for the organized market to capture the market from the unorganized sector, right? So you can see here, earlier the unorganized market in 2015 was 68%, which is now around 60%. And it is expected that in 2025, it will go down to 47%. Now, in case of organized market, organized standalone market, 23% was the share of share in 2015, which has increased to 28% in now, and expected to increase to 35% 5 years down the line. Now, look at the chain market. It was 6%, now 9%, and expected to be 15%, right? And that is where these QSRs, that is where the QSRs lie, right? And that is where the opportunity is. Just look at the sheer size of the opportunity here. If you look at in terms of numbers, today the food service market is 8,36,600 crores, which is slated to double by 2025, which is 17,22,000 crores. That is what we are talking about, right? And look at the kind of growth rate it had in the past and what we are expecting in the future, right? Similarly, in case of transactions and outlets, you can see how the growth has been happening in the past and what we see in the future. Now when you break it down to how much of the growth is coming from QSR, from CDR, from other parts of the market, you will see the growth has been clearly the fastest in case of QSRs. You can see even in FY 10 to 15, it grew at a CAGR of 29%. Then from 15 to 20, it grew at 19%. And the expectation is from FY20 to 25 also, it will grow at 23% CAGR. None of the other segments have that kind of growth built in them, right? And in terms of market share also, it continues to increase year on year, and pandemic actually only helped in increasing the pace of this shift, right? Now, if we break down the QSR sub-segments, we can easily see that burgers, sandwiches, and pizza, these two are the biggest categories, and rightly so, because these are the most convenient food and they take almost 10 minutes to prepare. So you order, you quickly get it, and you can finish it off. You can even have a bite while walking or while people eat while driving. So it's very convenient to just order, and we are living in this fast world where people don't have time. We eat while we are on calls, we eat while we are watching TV, we eat while we are having a discussion with our clients or friends. So that is how this segment will continue to be the largest segment, the segment of burgers, sandwiches, and pizza, right? And in terms of market share, you can see apart from the unorganized or the others segment, you can see clearly Domino's is the leader with 21% market share, and then it is followed by McDonald's and KFC, Burger King, and Subway, right? Now, if you recall in our presentation on travel industry, where we also covered the company of VIP Industries, we had this slide on mega trends. So if you recall, if you have gone through that slide or if you were present in that webinar, you would recall that VIP was a beneficiary of 5 out of 7 mega trends. But you will be surprised to know that in case of QSR, they are actually beneficiary of all the 7 mega trends. Let's go one by one. In case of IT revolution or internet penetration, of course, they are a beneficiary because ordering online is seamless. It adds to convenience. It helps them make more sale. It also makes the customer more happy and more satisfied because sitting in your room, even while we are having this webinar, some of you can probably order while listening to us. You can still order your pizza or burger, and even when the webinar will be going on, you might get them delivered at your place, and you can have them while listening to the webinar, right? Second is urbanization. Of course, urban areas are better penetrated by QSRs, and as more and more people are shifting from or migrating from rural areas to urban areas, that is only going to help these QSRs, right? Because that will increase their market or addressable market, right? Third, we don't need to say much about the consumption boom because, of course, consumption boom will reflect in food as well. Women in workforce. So I can very well understand the power of women in workforce because me and my wife, we both are working, right? So there are many occasions where we don't have time. We don't go home at time because we both are at work. So many a time we have to order from outside. So if women are in work, and this is again an irreversible trend, again a mega trend. More and more women will definitely be in workforce 5 years from now, 10 years from now, 15 years from now, or even 20 years from now. So that is also going to add to the market of QSR, right? Digital transformation. We have already covered the kind of work Domino's has done through its own apps. So the app, people don't understand, or even some of the investors don't look at it in this way. App is not just a mode to make it easy for the customer to order pizza and get it delivered to his home. App is a source of data for the company. The company, while analyzing analyzing its customers' pattern, they can customize their plans according to the taste and choice and preference of the customer, and present those kind of offers which will be too good for a customer to refuse or not take. And that is how the digital transformation is helping many of these QSRs, right? Unorganized to organized shift, we have already seen in the previous slides how the shift is already happening in this QSR space. And COVID-19 definitely has accelerated that pace because of the presence of these food aggregating apps, right? And the last one is demographic evolution. As the rising share of working population, because we see more, and India is probably the only country where the majority of the population is working population. If you look at any large economy, be it US, be it China, be it anything, any country in the Europe or Japan, all these large developed markets, they have aging population. India is the only country where we have working population. So working population is the actual target market for these QSRs, right? So again, if you just recap all these 7 mega trends, QSR is going to be a beneficiary for that. And when a company or a business is a beneficiary of so many mega trends, if they keep their act together, you have to understand as an investor that these businesses will not be available cheap. Don't get us wrong, we are not recommending go and buy them today. But we are trying to tell you this, that a company or a business which has long-term tailwinds, secular tailwinds which are not cyclical. In fact, if you look at what happened in COVID, these kind of businesses would probably be called as anti-fragile in terms of what Nassim Taleb says. Because what COVID did to them, actually, COVID was a very difficult period for all human beings and also businesses, right? In that kind of period, they not only survived, but they are actually thriving. That is what you should understand and notice in these kind of businesses. Of course, we don't mean to say that go and buy them at any valuation, but don't think that you will be able to get these kind of businesses at a valuation of any other, say, manufacturing company or any cyclical businesses. So keep that in mind when you are studying a QSR. So just a disclaimer, these 7 mega trends which we are talking about, it was taken from a very good talk from Mr. Utpal Sheth. His lecture is available on the YouTube. It was done in the CFA Society in the year 2019. And we would again highly recommend you to go and watch that, because that will not only make you understand the mega trends, but in that lecture, he talks a lot about different industries. So we would definitely recommend you to watch that. So before we move ahead, anyone wants to ask any questions?
Hey, hi Ankit, Amandeep here.
Hi, Amandeep. How are you?
All well, nice going. So, one question. So, since you studied these companies in general, do you have any tentative idea of how much was the volume growth and how much was pricing-led growth in the, let's say, last 4 or 5 years?
We have not been able to get that kind of a breakup, Amandeep. But if anyone has that, you can share it with us. We would love to know. And
So
today's
yes, please.
presentation, in today's presentation, our focus is more towards understanding the industry.
Got it.
And maybe you joined it a little late, so we shared it in the beginning. That today's presentation is basically to understand the whole industry per se, and
Got
we'll
it.
take a bird's eye view of the top 6 players. And
Okay.
after the presentation, we would request all of you to share your choice of companies which you want us to deep dive, so that in one of the subsequent webinars, we can cover them in detail. And then we'll probably look at this volume versus price movement, which you're talking about, Amandeep.
Got it. But I'm expecting that these businesses have pricing power because the asset turnovers are quite high. That's what I would assume here. So they must be having price.
See,
This price
if you
rising.
look at the long-term thing, see, just do this simple math. How much did a pizza cost when in
Yeah,
2002, 2004?
exactly.
And how much
Exactly.
it cost in 2012 and how much it is costing today? You will see a clear cut uptrend. So there is no doubt about that. And it's not just about pizza. The same thing is with burgers, same thing with other items as well. So there is no doubt about the pricing power, right? And it reminds me of, I don't know who said this thing, that there are some some industries where there is space for a lot of players. So I think one of the investors even mentioned, I'm forgetting who said this, that go to that kind of pond where there are many fishes. What does he mean by many fishes? That there are many investment opportunities. Because even though there are so many QSR players, the competition is not as much as that you will think that because there is a Burger King, Domino's, McDonald's is not going to sell more. McDonald's and Burger King both can thrive in this. The market is so huge, as Akhilesh mentioned, about the size of the country compared to what it is in US. And if you look at the history in US, you will see that they are not actually competing. The market is so large that not just two players, there can be 3, 4, 5 burger players in India, and they all can thrive in this kind of environment,
Got it.
provided they do their basics right. Dhruv has mentioned something in the Jubilant's recent con call. They mentioned about the price hikes, which they have done and have been received well with the customers. Yeah, thanks, Dhruv. So, Amandeep, Dhruv has answered your question.
Okay. Thanks, Dhruv.
As in general, the key proposition for them is providing best value, and they use a metric named NPS to see if the customers are satisfied with prices and do tinkering in prices on the basis. Thank you, Dhruv.
One more question, Ankit. So again, if it's not relevant, if you did not prepare that, it's totally okay. So would you have any slide on pricing in general, valuation metrics? Let's say what we are getting in India versus what we are getting in US. Is there?
We don't have any slide as of now, Amandeep, but I would urge you to probably not compare them. The reason being, again, I'll go back to what Akhilesh shared, the kind of growth and the kind of opportunity you see. So let me give you a different analogy. A JP Morgan bank today is priced at, say, 1.5 to 2 times book. And HDFC Bank, which has not performed in the last 2 years of the pandemic, even then it is trading at 3 to 3.5 times book. So would you say that HDFC Bank is expensive compared to a JP Morgan bank? I would say no. The reason being, the kind of opportunity in India even today, even the kind of growth we are seeing in the NBFC and startup phase gives you an indication that so much of India is still unbanked, and the credit India still have a lot of people who have never seen credit at all. So same thing you can apply in QSR as well. So if you will compare the valuation in terms of the PE or PB or price to sales or EV by EBITDA metric of Indian QSRs with the QSRs of say US, I would probably say it will not be a good exercise. I may be wrong, but probably that would not be a good exercise. So just another example is Nestle Switzerland and Nestle India in the last 10 years. Look at their valuation and look at the stock performance, right? So Nestle Switzerland is the parent company, right? Right, Amandeep? Do you have any other follow-up question?
Yeah, thank you.
Okay. Any other question, or shall we begin? Shall we move ahead? Okay. So we'll move ahead then. So apart from these mega trends, there are three other growth drivers for these QSRs. What are these three? Number one is the growing middle class aspirations and income levels. So we all have seen that in our family in the last 20-25 years. That our ability to spend 20 years ago was completely different to what it was 10 years ago to what it is today. And by and large, in most families, the ability to spend is getting better and better, right? Second big change is eating out is becoming a habit. 10 years, 15 years back, it was not a habit. It is now becoming a habit, right? There would be some exceptions. That's a different matter. But by and large, as a country, we are now getting into a habit of eating out a lot, right? And then the growing food delivery market. Just look at these numbers which are projected. So currently we are somewhere between 10 to 12 billion US dollars in India. And pre-COVID, it was projected that this will rise to say $16.4 billion. But now the kind of impact the COVID had in this business, the current projection is even higher than that, which is around $18 billion. Now, we'll cover some key metrics which we should look at while analyzing QSRs. Number one is same sales store growth, which is known as SSSG, right? This metric has been long held, I would say probably 30-40 years old metric this is, wherein all these QSRs rapidly expand their outlets. So they will keep on making new outlets. But as an investor, you should focus on whether each store is on a regular basis, they are earning or they are growing their sales or not. So while on consolidated level, the revenues may rise, but if all the revenues is coming from the new stores and the old stores businesses are not growing, that should be a worrisome point for you. See, there could be a time when this SSSG rating could be in a lower band, say about 3 to 5%, and there will be time when it would be around 5 to 8%. But it should not be in a zero or negative territory. If that is happening, that means there is something wrong with the business model. Growth in the number of stores, of course, QSR is even for delivery. Even if you say that you are focusing only on delivery, you can't do delivery if you don't have stores near it, right? So you need more and more stores, more and more geographical penetration to grow your business. Geographical reach. There are some QSRs which are only focused on one or two geography, but the best of the QSRs are all over the country. They are present in the north, in the east, in the south, all around. Logistic expertise, we have already discussed, so I'll not dwell much about it. We have already covered that in the first few slides. royalty expense. So royalty is a very important part because there are most of the QSRs in the country are basically US based companies where the has a US based parent, where say for example in case of Domino's, the Domino's is the US based company, and in India Jubilant FoodWorks has taken a master franchisee for India. So every year Jubilant FoodWorks pays a royalty to the Domino's to run their business, to continue their association, right? So this is also an important part. If the royalty expense is going to be a much higher number, that is going to eat out the margins of the player. So you have to keep on this metric also. Then of course the EBITDA margin. If the company is not being able to maintain EBITDA margins, a decent EBITDA margin, that means they don't have pricing power. I think somebody, Amandeep only asked about pricing power. So a very good way of looking at whether these companies have pricing power or not, you have to track the margins. If they don't maintain a good margins, that means they are not having any pricing power. And definitely this is pretty simple to know. Ultimately, QSRs are one of the fast growing category. If a QSR is not being able to grow fast, if a QSR is showing no growth or very small growth, that is a cause of concern, and you should probably dig in further and see why it is not growing. So that was all about the industry. Now we will briefly explain top 6 QSRs in the listed space, and we would like all of you to pay attention to all these 6 companies and take some time and let us know after this presentation at your own convenient time on which company you would want us to deep dive and present to you, right? So these are the 6 QSRs we are going to cover today. Jubilant FoodWorks, Devyani International, Sapphire Foods, Westlife, Burger King, and Barbeque Nation. So Amar actually asked this question, and we mentioned that Barbeque Nation would not strictly counted as a QSR, but for simplicity perspective, we have included it because it is also having a decent amount of delivery business now, and it is growing fast, and we believe that will form a meaningful portion going ahead for them. So it would be better if we also include Barbeque Nation in this presentation. So we'll start with Jubilant FoodWorks. Just a basic overview of the company. It is part of Jubilant Bhartiya Group, India's largest food service company, 1,435 restaurants, 307 cities. It has exclusive rights. So you will understand what is exclusive, because when we'll cover some of the other companies, you will see they don't have exclusive rights like Jubilant, right? So it has exclusive rights to develop and operate Domino's pizza brand in India, Sri Lanka, Bangladesh, and Nepal. And not just this, they also are adding further new brands in their kitty. So they already have Dunkin' Donuts, and mind you, Dunkin' Donuts is also doing well. They serve donuts, coffee, beverages, sandwiches. Hong's Kitchen, which serves Chinese cuisine. Chef Boss is basically a ready-to-cook sauces, pastas, and gravies. Ekdam is a biryani brand, which also serves, apart from biryani, kebabs and curries. And then there is Popeyes. Popeyes is basically a sort of a competitor to KFC. It focuses more on items of chicken, right? So in case of Popeyes, they have exclusive rights for India, Bangladesh, Nepal, and Bhutan. Now, I really like this slide from their presentation. This one slide basically gives you a very good understanding of how they focus on their business. So they obviously they have this Domino's branding power. They continue to innovate. If you have been a user, I'm sure most of us are already having some experience of Domino's over here. So you would have seen how over the last 20-25 years, they have evolved in terms of the kind of menu they have, the kind of experience they give in terms of different kinds of menu, different kinds of food, how you can order, what kind of offers you get. And because of their strong digital and data strengths, they continue to delight their customer, customize their offering based on customers' need, and continue to grow, right? So they focus on process, productivity, partnerships, and there are many stories about Domino's. You can just type in Google Domino stories and you will get to know about many innovative ways they have solved a problem. Like in case of the pandemic, when the pandemic hit, Domino's was probably the first QSR which started working with no touch policy, wherein if you order a Domino's pizza, the guy will come to your. The government came up with this policy much later, but they on their own innovated this thing and they started delivering much ahead than other QSR players. Only after when Domino started doing it, other people started copying it, right? Pros and cons, of course, exclusive franchisee of a successful brand does have, and we have seen that how successful it has been over the last 20-25 years in India. Logistic expertise, cost advantage. When you scale up, of course, you get a lot of cost advantages. You get better bargaining power when you look for new stores. Innovation and affordability, we have already discussed in the previous slide. And then strong growth in new stores. So just in case of FY22, their earlier guidance was 160 to 175, which they have already covered in the first 9 months. So the FY22 is now they are saying they have revised that guidance and now they are saying that they are on course to touch 200 stores, right? Now, in terms of cons, what we have written here is mostly the cons or the risk in case of any other QSR player. The fast rising competition at the current juncture, the competition doesn't look like very much in the sense that at the current juncture, it looks like there is a space for multiple players in this field. But if the competition continues to rise in this space, who knows, 5 years down the line, 10 years down the line, it will eat up the margin or market share of the incumbents, right? Cost pressures, as of now, we see that there have been pricing power, but if the cost continues to go up, how the demand will pan out, that only time will tell. So history says that they have been able to pass it on, but that doesn't mean that it will continue to be that all the time. Slowdown in new store opening, that's a real risk always. If the company, so this is one business where you have to continuously grow. And to continuously grow, you have to continuously look at expanding new geography, new stores, because that is the only way to increase your scale. So if you slow down there, at the moment, India still has a lot of places available in the country where the pizzas and the burgers have not yet reached. I'm talking about the organized pizzas, organized chains of pizzas and burgers, right? So there is still a lot of headroom in case of India, but that doesn't mean that it can continue forever. We have to keep on tracking it. Changing taste of customers. So one of the participants did ask about the quality of food, and then these are unhealthy foods. How long we'll continue to indulge in them? The history says that it is very difficult to change human patterns and way we eat, but who knows if things change in that way. And then last one is a very common one, which is economic slowdown. if there is an economic slowdown, of course, you will have lesser income to spend on these kind of items. You will probably cut down on your spending on these QSRs at that point of time. The second company is Devyani International. So Devyani International is the largest franchisee of Yum brands in India. So Yum brands basically own the Pizza Hut stores. So there are many Pizza Huts and KFCs open in India through different operators. But Devyani has been the largest franchisee of Yum brands in India. And not just that, they are among the largest operators of chain quick service restaurants in India. Now, when I'm talking about largest operators of chain QSRs in India, we are not talking about the exclusive one. Over here, we are focusing on the non-exclusive one because they don't have exclusive rights. They have non-exclusive rights, right? So there are other players also in the country who are opening Pizza Hut and KFC store. They have three different business lines. One is the core brands, which are operated in India, and there are three basic core brands, which is KFC, Pizza Hut, Costa Coffee. In case of international business, they have KFCs and Pizza Hut stores operated in Nepal and Nigeria. And then they have other businesses in terms of F&B. And over there, they have brands like Wango and Food Street. So more than 90% of their revenue comes from their core brands only. So right now, as an investor, we have to focus how their core brands are doing, because international business and other businesses are really minuscule part of their total revenue. Look at how they have performed recently. Just look at the net new units for Q3 FY22 and the stores at 31st December 2021 and compare it with stores at 31st March 2021. KFC from 264 has gone up to 339. Pizza Hut from 297 to 391. Just look at this. 100 Pizza Hut, close to 100 Pizza Hut stores have opened in the last 9 months for them. So they earlier projected about 100 Pizza Hut stores for the whole year, which they have been able to do in the first 9 months itself. The Costa Coffee chains from 44 to 50. And then in Nigeria, they have increased their store count from 24 to 28, and in Nepal from 13 to 18. These are the store expansions. You can see again here in the NCR region, from 135, they have increased to 148, Bangalore 80 to 100, Kolkata 42 to 52, and similarly in other areas as well. And you can see in their non-metro areas, they have expanded a lot in the last 9 months. From 48% share, it has gone up to 51% now. Now, one thing which they have recently changed in case of Pizza Hut is actually Pizza Hut has recently started following what Domino's has been doing for several years. Pizza Hut earlier was predominantly a dine-in restaurant, which, as we have discussed earlier, which requires a lot of capital, which has a lot of fixed cost built into it, and it is difficult to scale up compared to a Domino's-like model. So 4 years back, they realized this mistake and they started the delivery. They focused a lot on the online delivery thing. But if you look at how the pandemic has gone, and if you see this data, you see how delivery has become a major driver of their growth here. And in fact, in the recent call, I think it was in Q2 FY22, this is what their chairman says. Pizza Hut is basically not dine-in now. It's a delivery store. But if anyone wants to eat there, we just give them the box. So just try to understand exactly this was the policy of Domino's right from beginning. You were always handed a box in case of Domino's, but in case of Pizza Hut, you would remember of very good cutlery, good plates, very good ambience, which now they are trying to understand and trying to copy what Domino's has done. So always try to understand this thing. See, in case of Domino's, things have been doing well in the last 20-25 years. So they have already reached a size. But in case of Pizza, they are very minuscule compared to Domino's. So if they make these changes, probably in case of delta, if we talk in terms of delta, the rate of change in case of Pizza over the next 3 to 5 years would be drastic compared to a Domino's. So as an investor, we should keep these in mind. So from growth perspective, probably a Devyani International would look more appealing to you compared to a Jubilant FoodWorks. Again, we are not talking about valuation yet. We are just talking about the growth perspective. You can expect a higher growth in a Devyani International compared to Jubilant FoodWorks, because in case of Jubilant, they have a secular growth path over the last 20 years and they have already built in a scale. But here you see a smaller size business which has recently done some strategic shift in their business model, which can actually give them a really good leeway over the next 2 to 3 years, which will show up in their revenues and profits. Right? Now comes Sapphire Food. See, Sapphire Food is also one of Yum's franchisee operators. It was set up as early as recently as September 2015, and they acquired 250 KFCs and Pizza Hut stores in India and Sri Lanka, and they have been managed by some private equity firms. And as it happens in case of private equity firms and all, they not only grow through organic routes, but also through inorganic plans. So they continue to have this plan in their scheme of things, where if they find any opportunity to acquire any brand, they will not hesitate to do that. You can see what Sapphire Foods looks like. So you can see the omni-channel mix. They are not only dining but also takeaway, and also delivery. And delivery forms 51% of their business. Again, that gives that is a good thing to have, because the higher the number of delivery and takeaways, the better it is for the QSR, because you have lower cost of serving a customer, right? Similarly, look at the number of restaurants. They have 251 KFC restaurants, 294 Pizza Hut restaurants, 5 Taco Bell restaurants, and in total they have around 550 restaurants. You can see here how the growth has been. So the margins have improved. The margins have improved for all the QSR players. Similarly, in terms of EBITDA, you can see they have seen a decent growth in EBITDA numbers from 2000 or 200 crores. They have reached to 220 crores. So little more detail about Sapphire Food.
Ankit, if I may ask one question, does Devyani also have Taco Bell franchises?
I don't think so.
And are we aware if they are allowed to, or is Taco Bell under the Yum brand? Because I don't know globally how it is positioned.
I'll have to look for it.
I
think
sure.
No, I think, yeah, hi.
Yeah, Karan, go ahead.
Yeah, they do have Taco Bell franchises and they are operating Taco Bell, I think. Like it was part of their DRHP, but it forms a very small part of their whole business, I think.
Even for Devyani.
Yeah, and Dhruv, so basically in case of Sapphire and Devyani, they have this category in the sense that ये geography में Devyani है और ये geography में Sapphire है. That is how it has been.
Correct. Yes.
So
But
they are allowed.
they are not stopped from opening those restaurants in their other locations. Like there is no this thing. Like I think we have for Westlife, it is that way that only particular zones they
So
can cater to.
Devyani can open the say small size Pizza Hut store in the place where Sapphire has.
Correct. True.
Right.
True. Agreed. Yeah. Okay.
So these are the details. With respect to each restaurant, there is a 10-year original term plus 10-year renewable term, right? And they pay a royalty fee of 6 to 6.3% of net sales.
Yeah, hi. I just want to interrupt once that I was mistaken here. I just took a look at the DRHP. They do not have Taco Bell, but probably like they can bring it in because they already have association with Yum Foods. So right now they have only Pizza Hut, KFC, and Costa Coffee stores.
So
Actually, to add on to this,
are we sure? Yes, are we sure that they are allowed to open Taco Bell? Because I don't know how the Yum franchisees work. Like, are they allowed, or it's like because then why wouldn't they have opened up? So that is something that we can question.
For each kind of brand, they have a separate franchising agreement. So I'm assuming that
whether Devyani has that. That is the question I'm asking.
No.
I don't think they are.
I don't think they would be having, because if they would have had it, then they would have opened it right. But
So
like maybe they do not have any plans to go in that way right now.
Correct. Yeah.
So this is Samar. I would like to add here. Taco Bell, actually, the master franchisee in India, it has gone to Burman Hospitality, New Delhi-based company. So they are the master franchisee and they will sub-franchise it.
Okay. Sir, can you name the name of the company?
Burman Hospitality. It is unlisted.
Okay. Thanks,
Samar.
Yeah.
So, and Dhruv, one more point. So in case of Pizza Hut also, it's not just Devyani and Sapphire Foods. There are many other operators of Pizza Huts in the country.
True.
These two are the probably the two largest operators.
Yes.
But there are very many small operators of Pizza Hut franchisee in India. Okay.
True. Yeah, that's a good one.
So these are some of the terms which they have with their parent company, right? From where they basically got the franchisee. Okay. And they are allowed in non-competing products with Yum's prior approval, right? As they have mentioned here. Then comes Westlife Development. And you can see Westlife Development is basically the company which has the franchisee of McDonald's. And they have been in India for about 25 years now. And you can see their journey as mentioned in this chart. Immediately once they launched, they basically modified their menu based on the local taste and launched products like Makalu Tikki Burger because they knew that it would be very difficult to straight away launch the Western products over here, because at that point of time, the market was not ready, right? And you can Google and find McDonald's have been really smart in making a lot of revenue per store compared to any other QSR player just by playing out with the menu option. They very intelligently place their menu options in such a way that as a customer you end up paying more to them and you don't feel it while you are paying. So that is how they manage. So there are subtle nuances in this QSR space where you can learn a lot from different players, right? Next time when you go into a McDonald's and then go into a Domino's, just try to see, or maybe a better comparison would be McDonald's and Burger King's, right? And try to see how much you are paying in Burger King and how much you are. Just try to make a mental note, write it down somewhere. You will realize that you end up paying more in a McDonald's and you don't even realize that, right? So,
Yeah,
so
I
they
think
had a very good.
the term for it is called hunger marketing, right? In which your whole meal costs less than the sum of its parts when it is like acquired, like piece by
Exactly.
piece.
Right, right, right. So we are. So I'm sorry to use that term. We are sucker for combo meals, right? Most of us get attracted to these combo meals. But if you make a very good careful observation of those things, you will realize that, as Karan rightly pointed out, having those four items separately would cost you lesser than the combo which you are opting for, and you get lured towards it because that is how they position themselves, right?
No, I
So
think Ankit, you explained it a little different, like a little wrongly. The thing is, like they place the combo it in such a way that you do not, you would always feel that you are saving more by buying the combo. Like for example, if you want just the burger and the cold drink and not the
Mhm.
fries, and if you go to buy the burger and the cold drink, then you will see that you just need to add like 20 rupees or 30 rupees more to get a fries.
Right,
Jabki
right,
a separate pack of fries is like 45 or 50 or something. So then you
right,
would be
right,
thinking,
right.
okay, I am saving a little bit on the fries. Let me buy extra because like
Exactly.
objectively you are only supposed to buy the cold drink and the burger. But then
Right,
because you are thinking that, okay, just add more and I'll save more. So you are
right,
like spending more at, on top.
right. So you originally didn't want a fries, but you ended up ordering it, right?
Yeah, yeah,
Yeah. So this is their journey over the last 25 years. So this is how they focus on. These three areas are their areas of focus. Menu innovation, as we have discussed in the previous slide. Omni-channel strategy. So there are many options. You can go dine in there. You can take away. You can order it through their own app, or you can order it through Zomato, Swiggy. And the third part, which is common for any QSR, is network expansion, right? This is how they have been growing through an omni-channel focus, and they've been able to capture customer use case occasions and expand the revenue pie. You can see that Q3 FY21 sales and Q3 FY22 sales, right? So you can see that the convenience portion has increased a lot in the last 1 year, right? So 55% growth, year-on-year growth in the convenience portion. Now comes Burger King's, which is named as the company of which is Restaurant Brands Asia Limited. So this is a national master franchisee of the Burger King brand in India. It launched their first restaurant in 2014, and they have very aggressive plans for restaurant openings. So basically, they plan to open 700 restaurants by December 2026. That's a pretty uh, steep task, and if they manage to do that, of course, that will percolate to their revenues and profits as well. So, but our view is that any company which is growing too fast, we should be a little careful and try to dig in more as to how they are growing fast. So if you look at their recent con calls and presentations, you will see that they've recently came up with the IPO, and they're again now uh, got a approval from their board that they want to raise more funds. So of course, this growth will come at a cost of diluting their equity, right? Now, whether that would be uh, remunerative for the shareholders or not, that only time will tell. But given a choice, we should always focus on businesses which do not dilute their equity. So if you look at Jubilant Food, they didn't dilute their equity to go from less than 500 stores to about 1500 stores today, right? So why would you bet on a Burger King? So until and unless you are very confident that the dilution of equity will bring in more growth, profitable growth, you should be a little careful. But you can look at the growth. It's right. FY15, they started, basically, they barely started that time, and they have quickly opened close to 300 stores now. And even from this 300, they are targeting almost doubling in the next 3 years, 3 to 4 years, which is phenomenal if they can do it. And let's see how it goes. So how they have increased their revenue in the last 9 months is by introducing this stunner menu. And if you can look at it, everything is priced at 50 rupees or 70 rupees. So all the veg items are priced at 50 rupees and the non-veg items are priced at 70 rupees. That is, these kind of price points attract a lot of middle class customers, because we as middle class people, we have a limited budget, right? So when anyone offers you these kind of offer, you tend to get attracted towards that, right? So you can see that how this growth, there has been 39% growth in stunner volumes since campaign break, right? And the campaign was launched in 15th of July. Now comes the last QSR company. In fact, as we had disclosed earlier, it may not strictly be under the segment of QSR, but from the sake of simplicity and taking it forward, specifically because of their delivery offering, we are counting it is and in the QSR segment only. So Barbeque Nation is a very unique offering, because they are neither like your QSR, typical QSRs of, say, burgers or pizza, which is very easy to make and quickly deliver, nor they are like fine dining restaurant where you have to pay a lot and you have to wait for the food, or you pay for the experience. Rather, it is more about the kind of food offering they are proposing. And most of their, in fact, majority of their business comes from their buffet, which basically is a fixed price buffet, and you can eat as much as you want. And only post the pandemic, when all the restaurants were shut, they started their delivery offering, and that delivery offering has gained a lot of growth in the small period of last 1.5 years. So the management is now mentioning in their calls about this delivery thing actually overtaking the dining thing very soon in the next 2-3 years. Now look at their store expansion, and remember, these are not franchisee. This is company owned stores, right? And FY15 to FY21, there is a 24% CAGR growth here. Look at the delivery sales, how it was, what it was 12 months back, and how it has scaled up in the last 9 months. You can see the numbers here, right? The delivery segment grew 64% in Q3 FY22, along with strong recovery in dine-in. Delivery segment was 16% of total revenue from operation in Q3 FY22. A new segment which was introduced during the pandemic already forms 16% of total revenue. That speaks a lot about the growth prospect in this particular segment, right? Now, with this, we have a fair idea about the top 6 QSRs in the listed space. Now let's try to understand from a valuation perspective. We all know that from the traditional matrix of P, price to sales, or EV by EBITDA, all these QSRs are really expensive. But we'll try to look in different ways how these QSRs are positioned. So keep in mind that most of these QSRs were listed last year along with new high-tech businesses, right? Last year saw all these stocks, not only QSRs, but also the high-tech stocks growing really fast, and it caught a lot of investors' fancy. All these stocks run up really fast. And in the last 2 months, what we have seen is all of them have gone down a lot. But when you compare the performance of the QSR stocks with the new age platform business, you can see that probably QSRs are doing much better. You look at Devyani, Burger King's, Barbeque Nation, Westlife Development, they are all, in case of Devyani, it's a 25% profit in the last 1 year. Barbeque Nation, it is a 2x. Burger King and Westlife are also down, but very marginally down. Now compare that with new age platform businesses where car trade tech is down 65%, rate gain is down 12%, this Paytm is down 50%, Zomato is down 40%. Only MapMy India is at a similar level from last year. So broadly speaking, in terms of the market positioning today, investors have more fancy for QSRs today compared to new age platform businesses. So one way of looking at it is maybe the new age platform businesses are available at a very reasonable valuation and QSRs are expensive. And another way of looking at it is this, that in times of uncertainty, investors will always look for safer businesses where you see far more predictable growth. So from that perspective, there is no doubt QSR businesses are far more predictable and the growth is already visible in their sales. If you look at the last 9 months performance, you will see that growth already. And it is easier for an investor to take a 1 year, 2 year, 3 year view for a QSR. But that is not something can be done for all these new age businesses, right? Most of them are running in losses. In fact, many of them are in cash losses as well, short of cash, right? Now, let's try to look at valuations of these QSRs. We have taken the top 6: Jubilant, Devyani, Sapphire, WLDL, Burger Kings, and Barbeque Nation. Okay. Look at the price to sales, EV by EBITDA. So none of them is available at a cheap valuation where you can just feel that now this is something which we can easily go and buy. But try to look at the sales growth and operating profit growth. That will give you a sense of understanding that the kind of growth which is available in this business. Barring Jubilant FoodWorks, which is probably having scale issues in the sense that they already have reached a scale, they growing at 50-60% is something which is unimaginable at this point of time. But if you look at Devyani, Sapphire, WLDL, Burger Kings, and Barbeque Nation, both sales and profit over the last 4 quarters, they have grown not 10, 20, 30%, but 50, 60, 70%. In fact, in case of Burger Kings, you can see the profit growth is 120%, right? So that is the kind of growth you are seeing. Again, that doesn't mean you just blind yourself and go and buy any of these. But the point is, the best time to buy them will be probably when there is a market-wide fall, like we are witnessing some sort of a market-wide fall in the last 2-3 weeks. If this kind of fall continues, say for another 1 month or 2 months, it makes sense for us to keep track these kind of businesses. And if they fall 20-30% from here, it would make sense to probably start building positions in some of them. We have not analyzed any particular business in detail. We'll do that in our subsequent webinars. But as a whole, QSR space is something which you cannot ignore if you are an investor in the long term and if you value growth. This is where growth is, and this is where a predictable growth is. Even those FMCG businesses which had been growing for many years are not showing any meaningful growth these days. So growth is there in this industry. Now, how do you want to buy? We leave it up to you. Jubilant has been a leader for long, but how do you see the growth here? Of course, you can't expect a 30, 40, 50% growth, but a 15 to 20% growth, even from current level, is something which is possible for Jubilant, because pizza is still an underrated, underserved category in India, and the kind of growth the new players in this pizza category are seeing. It would be fair to assume that Jubilant may also grow from the current level also, from this size as well. They can grow to at a CAGR of 15 to 20%. Now, for that, how much you want to pay? That is a question. In case of other QSRs, the growth would be much more faster. So whether you want to go for those QSRs or Jubilant, that's up to you. That depends upon your risk appetite. But always remember that market gives premium to growth. DMart and Bajaj Finance, we have seen as investors, you keep on looking at these businesses and saying that these are very expensive. We will buy only when it is available cheap, and they are never available cheap. DMart and Bajaj Finance are two examples. But on the flip side, the market also punishes when the growth disappoints. Even great businesses like Eicher Motors and Page Industries, at the peak of the cycle in 2017, Eicher Motors was 10 times sales. Today, 5 years later, and doing a lot of headroom in the export market, still Eicher Motors have not been able to go past its 2017 peak price, right? Similarly, in case of Page Industries, at one point of time in 2018, it was 18 times sales. So it came down sharply after that when the growth stalled in one of the years. So this is the risk when you pay too much for growth. It is good to look at high growing sectors, high growing companies, but we have to be mindful of what we are paying for this growth. Another thing which we would want you to look at is just look at the top 6 QSR companies in India and the top 6 hotel companies in India. You would be surprised to know that the QSRs today are higher, the valuation of those are higher than the hotels. You would tend to say that if you calculate the properties of these hotels, the land banks and everything, probably these hotels have much more value. But market doesn't give value to the properties. Market gives value to the earnings and the predictability of earnings. If you take a 10-year view from here, there is a higher chance that QSRs will probably grow much more than hotel companies in the long term. For the next 5 years, there is a case that hotel companies may outperform QSR because of cyclical recovery in the hotel segment. But if you take a long-term view where these cycles play out, where you have a 4-year, 5-year up cycle and then 4-year, 5-year down cycle, it is easier to assume that probably these QSRs will have a much higher market cap compared to hotels even 10 years down the line. So just something to keep in mind. And now if you think that Pizza Hut has been there for 20, 25 years, McDonald's have been there for so long, there are so many QSRs, the growth cannot happen, it cannot keep on growing indefinitely, right? There could be these kind of thoughts which come to your mind, but try to go back to the main things which we discussed in the earlier slides, where it's all about convenience and removing friction. So there are still areas where these QSRs have still not tapped. One such area or one such friction which can be removed is what we'll present in the next slide, and which is our okay. Before that, we'll compare the. So if you remember, we'll come back to that the thing which we were discussing about, where these why these QSRs, after so much growth in the last store count, and Burger King's right now is 320, but it is fast approaching 700 stores, which they mentioned. So this is the closing thought we would like to leave you with in terms of the future of QSR. The point we were discussing prior to the last slide is that how much more convenience can be brought into this sector, how much more friction can be removed. So you can see here, we have just put one tweet on the left hand side. So there is a company called Doge Burger. So people who are accustomed to cryptocurrency would very well know about Dogecoin, right? Let us put this disclaimer: we are no crypto experts, but cryptocurrency is fast getting accepted all around the world, right? So this is one company, Doge Burger, right, which basically sells burgers in exchange of crypto, which is Doge. So you can basically, you don't have to even pay in cash or through credit card. They will accept your cryptocurrency. So again, that again reduces another friction. It becomes more and more easy for you as a customer. In India, definitely crypto has not been that easily accessible today. But who knows, 5 years down the line, 10 years down the line, crypto becomes a part in Indian economy as well. And these kind of scenario can play out in India as well. Just try to imagine what kind of growth that will bring in, right? So with this, we come to the end of the presentation. Thank you for patiently listening, and we can now take up the questions.
Hi, Ankit. One
Yeah.
suggestion: while the first slide talked about, while the whole presentation is on QSR and everything, but if we sometime in the next presentation also can analyze the organized listed restaurants, which might probably just include specialty restaurant also, which is also a small chain, of course, but the whole thing is about fine dine, not about delivery and everything.
Right.
It can throw up opportunity, because at the end of the day, it's all, we are playing the same thesis in terms of growth parameters and everything. And so it might be helpful in making a decision of where to enter at what point of time.
Sure. So I think Dhruv wrote something that there was
No,
a
that yeah, there was a lag. I don't know how others faced or not, but I did face between once.
okay, got it. So Dhruv, in terms of the specialty restaurant, and also I'm sure you would have looked at it. Looked at the past. There were some. So they have not been able to scale up in the past as well.
True. Yeah. They have, because it's a
So
fine line thing and it requires heavy
right.
this thing
Right.
capex
So
in terms of building up and everything. True.
yeah, so we can take it offline and we can discuss on this. But
Okay, fair.
basically our focus is more on the QSR thing, because QSR is something which clearly says that there is which clearly shows that there is growth at stake, right?
True.
So it makes sense to focus more on. But I would love to discuss on specialty restaurant as well. And in fact, I
Sure.
remember at one point of time it was touted as a turnaround story in 2018 and 19, but it failed miserably, I guess.
Still, it is touted as that.
So reminds me of Warren Buffett's quote: "Turnaround seldom turnarounds." Right.
True. Yeah, absolutely.
So thank you so much for listening patiently. If anyone has any more question, we can discuss it.
Yes, sir. One thing actually I want to say.
Yeah. Yes, Kailash.
Yes, sir. Actually, I have two things to say. Actually, on Burger King, actually, sir, the QIP was raised actually for the Indonesian operation. So Indonesia is also one of the, largest 5 populous country actually in the world. So actually, it was the, exclusive rights for the Indonesia also. So the Burger King actually is the master franchisee actually for the India as a whole, as a country, and the Indonesia as a whole. So, it's just on a, add-on kind of a thing actually I want to say on Burger King. And sir, another thing actually that actually, is on a based on a the broad-based thing that actually Jim Rogers is, talking since last few interviews, that actually the time for the agri commodity actually has come. The average age, of the farmers actually in all the developed country, he counted actually it's very low. So what he was talking about, the time for the agri commodities has come, and you are going to see the boom in agri commodities that we are seeing in all sorts of oils and cereals and everything. So being the basic raw material actually for this QSR, the whole thing hovers around this raw material like agri commodities. So your call on that, because actually we have seen in the past that actually whenever your raw material prices hurts you, even if you have the pricing power, but the kind of the returns, the kind of outcome that any company or the performance that delivers actually, it's not always the way actually you want. Actually, if raw material are hurting, are moving in wrong opposite direction to your interest. So broad-based call actually from you, actually take on this.
So nice questions, Kailash. I think you asked 2 questions. Number 1 was on the Burger King. So basically, number 1 was not a question. You just mentioned about this. You're right. It is about the Indonesian operation, and so we are not taking it in a negative light. We are just saying that whenever a company grows fast and it is diluting equity to grow fast, so it doesn't mean that it will necessarily be detrimental to the equity shareholder. But as an equity investor, you should pay more attention to see if they are diluting this equity. Are they actually promising much higher growth or not? That is what you have to be mindful of. Of course, we also appreciate the kind of growth they have been showing in a very short period of time. So it's just that these aspects we wanted to be all of you to be aware of. That's it. And coming to the second point, I would give you an analogy of what happened between 2003 to 2007-8. So that was also a very hyper growth period for the Indian economy, and there was a good high inflation during that period. So going by your logic, at that point of time, all the two-wheelers were still under-penetrated in 2002, 2003. So even though they grew, going by your logic, they should have also faced margin pressure. And I'm talking of two-wheelers like Hero Honda and Bajaj Auto, who are not, what do you say, premium brands. They are mass brands. So when you compare the pricing power of, say, a QSR compared to a Bajaj or a Hero, I would say a QSR has a much higher pricing power. But if you go back into the history and you check the performance of both Bajaj Auto and Hero Honda, you'll be surprised to know that they did phenomenally well in in passing on the price to their customer. So I would probably feel that looking at that part of the history and believing that QSR has a much higher pricing power, and because the ticket size is much more smaller when you compare it to a bike, yeah, and the kind of expense you make while you go to a QSR, you don't feel the pinch. Say, for example, you buy a pizza, say about at 300 rupees. After 6 months or 1 year, if they change the price by 30 rupees, it is a 10% increase in price. But when you will be paying 330 rupees, you will not feel the pinch, because in an absolute manner, you're not paying too much for that, right? Just look at how the inflation is there in the milk. The price of milk is increasing every quarter, but we continue to consume it, right? Of course, milk and QSR are not the same. But my point is this, that even though I take your point that every commodity may see a huge inflation, but that doesn't mean they will not be able to pass it on. I would probably bet that by and large they'll be able to pass it on.
Excuse me, just I would like to say something.
Yeah.
I remember in the year 1996, first time I saw.
Ganesh, just
Yes,
actually I can see Amar's hand being raised for a long period of time. So let's give him a chance first.
That's okay, Ankit. I can go after Ganesh.
Okay, please go on, Ganesh.
Thank you. In the year 1996, I saw pizza for the first time in my life. It's a standalone restaurant at Chennai. The cost of pizza was 25 rupees at that time. It was a novelty, and people used to go and have pizza for lunch. So now, if you look at the price of pizza, now we can see the pricing power.
So I don't remember whether it was 25 or not, but see, everything from a 20-year perspective, everything, price of every food commodity has increased in that fashion only. You can check the price of any other material also at that point of time. Bread used to be available at 8 rupees in 98, 97, when the first time you would have, well, I'm not saying first time you would have seen bread, but I'm talking about a 20-year period. So today those loaves of breads are available at 40 rupees, right? So you see that change. From 8 to 40 means 5x. So similarly, from 25 to 5x, you still see 150 rupees pizza being available in the market, right?
And so the last thing on the continuation of this. So looking at all these franchises, actually, one thing actually that is prima facie quite clear to me, that all the other franchises, all the franchises are being given by the, their MNC counterpart actually to the locals. And in case of Burger King, it's their own entity that is operating. So we had seen the risk of, actually owning the franchisee in case of, this Hitachi, this Amaraja and Johnson Controls and Hero Honda as well. So, and looking at the, the clash that this McDonald had actually with their North, operator, for quite a long, maybe cannot restaurant kind of brands, or, there was entity actually, there was a clash for the North Indian operations of Westlife. So, and so, sir, looking at all these, things actually in, taking the perspective of those things. So it seems Burger King India is placed quite, on a safe, zone actually when it comes to being operated by the company itself. So your thoughts on that, actually, owning the risk of, a franchisee as well as company owning, this, the company's affiliate?
Yeah, fair enough point, Kailash. So I agree with you here, because of course, when you have an exclusive right, master franchisee for a country, you are in a much better position compared to where you are competing with other operators in that. And you have rightly mentioned about the McDonald's franchisee and all, but also keep in mind this thing, that McDonald's, when you're talking about the the WLDL franchisee of McDonald's, they have been here in the country for 25 years already. And they already have a very good network of stores all over the western and the southern region. So even if they cater to this portion only and add that to the delivery market and the growth prospect there, they have that advantage. Now, Burger King, by being more aggressive towards growth and having a master franchisee, may take over them in the next 10 years, 15 years, who knows? But at the current moment, we would say that it's not an easy thing uh, to challenge McDonald's in the country, right?
Sir, actually,
And
sir, I'm just missing, sir, one thing actually I had to come in. Sir, is this Burger King India actually is the company, is the subsidiary of, restaurant brands worldwide, or is there something, a company that is operating in India actually, and those who have taken the master franchise from Burger King India? Because I'm missing here. What is just simple, if the Devyanis might or the Sapphires might actually compare to Burger King Worldwide's might, if Burger King Worldwide is operating in India through its own company, it's not the master franchise that they had given to somebody.
no,
So just I
it's
want a
not
clarity on this.
it's not their own company. It's a master franchisee which has been taken from Burger King USA.
Okay,
So it's not
okay,
their own company. Yeah.
Okay, got it. Okay.
Yeah, Amar, please go ahead.
Yeah, Ankit. 2 points which I wanted to mention. First one, I think we already discussed. One, from an antithesis perspective, end of the day, QSR is going to be a discretionary spend for us, right? And looking at the scenario, I'm kind of coming to inflation part, where the oil rates go up, Fed rate increases the interest rate and all that. Eventually, inflation actually is already there, even though government is not agreeing to it outright. But if you
Right.
look at the Q3 FY22 results of many companies, they have
Obviously.
taken a hit on the raw materials and all, right? And from
Right.
here, at least for the short term, it is going to worsen. So that was one thing which I thought might be a negative for in the short term for the QSR. The other part which we talked about is Jubilant FoodWorks. If we look at it, its all-time high is about 4,500. And in the past 4 months itself, it has fallen down 36% without much change in the business or the parameters or other things, right? So it has already fallen 36%. So
Mhm.
compared to 4,500, I think it looks a bit more attractive now at 2,900 when compared to its all-time high. So that will be one point which we have to keep in mind when we do our valuation exercise for the companies which we are looking at. So
Right.
Jubilant Foodwork, and it is already proved. Its business model is proven. It has achieved a scale, and it might not grow phenomenally like Burger King in 50%, 70%, but safe
Mhm.
to say that 50-20% growth we might still see going forward. So those are
Yeah.
the couple of points which at least I have in back of my mind. I had not specifically looked at QSR because the valuations were always high, right? So
Right.
I will have a look at those. So Jubilant is one thing again is like since it has been in the market listed for so much time, there is solid data which I can use for my analysis. But same is
Right.
not the case for Sapphire and Devyani because if I look
Right.
at the last quarter or something, I see them projecting losses only, which might be part of the growth, right? But then
Mhm.
that is where I kind of stumble. So, but like you said, I'll wait for the follow-up class and then we can discuss more how to value them actually.
Sure. So, Amar, on your first point on inflation, so inflation is obviously, you're right, you're bang on that if you see the Q3 results of most of the companies, on the raw material side, almost everyone is facing the heat, right? So that part is there in case of them also. But the only part, or the only advantage these QSRs are having is that they are in an advantageous position compared to other industry players in terms of passing on the price hike. So when you make as I mentioned earlier, when you make a 10% hike on a pizza or a burger, the customer doesn't feel that kind of a pinch because your customer on an absolute basis pays say 30 or 40 bucks more, right? Which doesn't pinch him a lot. But when you are making a bulk order to your customer, say you are a manufacturing company and you are shipping your products to a multinational company and you are then asking them to pay 10% more, that is where you will face more problems. So that is one. Of course, it's not that inflation will not hurt them, but they will hurt them much lesser compared to other businesses. That is one. And second, in terms of what you're talking about, Jubilant compared to others QSR players. So there is no doubt that Jubilant has already proven itself and it's there. So that is always the dilemma in terms of an investor, whether you pay high for the growth or you pay high for what has been achieved in the past. See, Jubilant, in case of Jubilant, so probably, I don't know whether this is the reason, but probably this is the reason why Jubilant has fallen down so much, because investors are feeling more value in other QSRs at the moment because of the growth prospects there, right? So these dilemmas will always be there, and basically investing is an art where you make some sort of a compromise. Either you compromise on the growth or you compromise on the value. So you can't get both. So when you get more certainty in case of Jubilant, even at 30% reduced prices, the valuation looks expensive. And when you are looking at other smaller players, the growth prospects are high. And given that growth prospects, the valuation looks better compared to Jubilant. But how confident you are that that growth will be sustainable? That is the question there, right?
Valid point, Ankit. Yeah.
So thanks, Amar. Nice question. And as we discussed in the beginning, please share in whatever mode you are comfortable with, maybe on email or Slack or on WhatsApp. Which of these 6 QSRs you would want us to, maybe 1 or 2 you would want us to deep dive, so that we can cover them in one of our upcoming webinars. If there are any other questions, we can take it up now, or it's already 8:15. We can call it a day then. So since there are no more questions, we would like to thank you so much for patiently listening to us, and we hope we could add some value. And probably after this presentation, you would know a little more about QSR and be much more informed if you look at investing in that sector. So that's it from our side, from SmartSync Services. Thank you again, and have a good weekend.
Thank you very much.
Bye-bye.
Thanks, Ankit. Have a good weekend, everyone. Bye.
Thanks a lot, Ankit. Thanks, everyone. Bye-bye.